Klarna, Goldman Sachs, Green Skies, Square, and PayPal. I know what you're thinking. Nate, that sounds like a random list of companies you just came up with right now. Well, oddly enough, all of those companies have one major thing in common. They're now all kind of in the same industry. In 2021, buy now, pay later companies have been taking the news by storm. And not only does it look like some major brands want to get in on the buy now, pay later craze, it appears as if the industry is growing. And buy now, pay later might mean a lot more than you think. So what exactly is a buy now, pay later company, and what exactly does that mean for your wallet? Well, we'll be discussing all of that and more in today's Business and Financial Breakdown, but before we do, I need you to do me a quick favor and smash that thumbs up button below and hit that notification bell too. That way YouTube can show our videos to other money minds around the world and we can keep making videos just like this one. Thanks for doing that. Buy now, pay later is essentially a fintech idea that has been around a lot longer than you probably think. One of the first big names in the buy now, pay later industry was Swedish company Klarna. Klarna would essentially team up with other companies in order to allow consumers to purchase items in 4 interest-free payments. Or consumers will have to pay off their purchase in 30 days or less. Essentially, this allowed consumers who didn't have the upfront cash for something to buy more things. And I know what you're probably thinking. That kind of sounds like a loan, right? Well, it kind of is, as Klarna and these other buy now, pay later companies essentially operate as a bank. So if you'd like to use this service, you're essentially not buying the thing outright. Klarna, or one of these other buy now, pay later services, are essentially buying the item on your behalf. So you don't owe the company that you bought the item from anymore, you owe Klarna. But the process works a little different than financing. See, when you need financing for something, a company will typically have to pull your credit report. Your credit report basically just shows how likely you are to repay that loan. Credit scores range from the 300s to a top score of 850. Your full credit report will show all of the lines of credit you have, as well as your full payment history, so creditors can see if you've made any late payments in the past. All of this helps them decide if they can actually give you the loan and give you that financing. But when it comes to these buy now, pay later companies, it works a little different. While you are technically financing something, these buy now, pay later companies don't need your full credit report. In addition, the purchases that you're actually making are typically much smaller. Financing is often reserved for major purchases like a new mortgage or a new vehicle or maybe just a new appliance like a fridge or a new oven. But these new companies like Klarna, Afterpay, and Square allow you to finance things for a much smaller amount. For instance, you can now finance $200 sunglasses instead of paying that full $200 up front. All these buy now, pay later companies need to do is perform a soft credit check, which basically just means they look at your overall credit score, the number itself, and then decide to give you financing or not. And like I said, this has now become a huge industry, as Klarna is now valued at around $5.5 billion. In addition, Goldman Sachs bought buy now, pay later company Green Sky for $2.2 billion, and Square recently purchased Afterpay for a staggering $29 billion. So what's with all these big moves in the buy now, pay later space? Well, simply put, companies are always trying to increase revenue. And when it comes to the buy now, pay later strategy, that's a great way to do it. Studies show that consumers are actually willing to spend more money when it comes to the buy now, pay later system. Because now instead of having to fork over $200-300 to buy the thing that you want, you can buy that thing for a fraction of the price. And because the model is so cleverly disguised, consumers don't really see it as credit. But at the end of the day, it's all considered debt, and it's starting to rack up amongst the younger generations. It still is credit, which means if you miss a payment, you could rack up a ton of interest. So what exactly is next for buy now, pay later? Well, if buy now, pay later strategies continue to catch on, we may see them integrated in small businesses and beyond. So you might see rollouts in your major grocery stores and your local corner stores. Credit cards and other loan providers themselves may also get on the buy now, pay later bandwagon. And because buy now, pay later companies don't report to the major credit bureaus, we may see a shift in consumers actually turning to those companies instead of the major financiers. That means it is possible that short-term installation loans may be the wave of the future instead of long-term loans. But only time will tell what exactly happens, so it looks like we'll have to wait now to see what will come later. But I want to hear what your thoughts are on buy now, pay later. Do you think it's the wave of the future? Or do you think that traditional financing will eventually crush the buy now, pay later system? Be sure to join the conversation and leave your thoughts below before you go. But that is it for today's Business and Financial Breakdown. Thank you so much for watching, and I'll see you all in the next one.